Hi everyone, I'm Brandon. Welcome back to Aura's Playbook. Today's episode is about the newly appointed Federal Reserve Chairman Kevin Warsh. And honestly, there's so much to unpack that I had to split this into two parts. Stick around for part two. Kevin Warsh, the highly anticipated new Federal Reserve Chairman, just presided over his very first rate-setting meeting. And honestly, the significance of this meeting far exceeds what most people could ever imagine. That's exactly why I need to break it down for you today. Look, when most people tune into a Fed meeting, they just want a one-sentence answer. Are they raising rates or cutting them? But here's the thing. If you only focused on the interest rate numbers this time around, you completely missed the point. The truly critical takeaway isn't whether rates moved. It's that the entire institutional personality of the Federal Reserve is undergoing a profound and radical transformation. Think of the old Fed like a considerate GPS navigation app, constantly reminding you along the way. In 300 meters, turn left. There may be a roadblock ahead. Please drive with caution. The Warsh-era Fed? It's a cold-faced judge. I can tell you the rules, but you navigate the road yourself. If you crash, don't blame me. So today's episode is not about a hike or a cut. What I actually want to dig into is how this shift in the Fed's personality will alter the trajectory of the U.S. economy and impact the daily lives of every single one of us. And more importantly, it answers a pivotal question. Will the man handpicked by Donald Trump truly become the puppet the president wanted him to be? Or will the Federal Reserve safeguard its most fiercely guarded virtue, its independence? So let's look at exactly who felt the impact of that first shot fired in the Warsh era. And honestly, the outcome of this meeting is dripping with irony. As we all know, for 2 years straight, Donald Trump relentlessly criticized the former Fed chair, Jerome Powell, blamed him for not cutting rates, accused him of suffocating the economy by refusing to inject liquidity. So Trump handpicked Kevin Warsh and put him in the chair. And Wall Street naturally assumed, with Powell gone, rate cuts were finally on the horizon, and cheap money was about to make its triumphant return. But what actually happened? In Warsh's very first FOMC meeting, the Fed chose not to cut rates. They stubbornly refused to offer even the slightest hint of a future cut. If anything, discussions inside the Fed have resurfaced about whether they might need to raise rates later this year. So let's take a quick look at what was actually communicated during this milestone FOMC meeting. First, the Federal Reserve decided to hold the federal funds rate steady. Their reasoning? The U.S. economy remains resilient. Unemployment remains low. Yet inflation keeps stubbornly hovering above the Fed's 2% target. And they closed with a pretty assertive line. The committee is firmly committed to achieving price stability. Now, an ordinary observer might dismiss that as boilerplate bureaucratic language. But under the Fed's previous communication style, the implicit subtext would usually be, "Do not panic. We will give you plenty of advance warning." This time, though, Warsh kept it incredibly brief, sharp, and entirely devoid of the traditional nanny-style market coddling. The message Warsh delivered was direct and uncompromising. The U.S. economy doesn't need a rescue package right now, but inflation is far too high. So, stop constantly fantasizing about rate cuts. Which brings us to the most critical and, honestly, the most intriguing element of the whole meeting, the FOMC's famous dot plot. Quick refresher. The Federal Open Market Committee is a 12-member voting core that dictates all major monetary policy decisions. That includes the 7 members of the Board of Governors, the President of the Federal Reserve Bank of New York, and 4 rotating regional Fed bank presidents. They meet 8 times a year, roughly once every 6 weeks. Here's how the dot plot works. It's essentially an anonymous exercise. At the end of each meeting, The 12 regional Fed presidents plus the 7 governors, 19 officials in total, each plot a single dot on a chart. That dot represents where they personally think the federal funds rate should stand at the end of this year, next year, and the year after. I emphasize anonymous because these projections are entirely de-identified. We can see how many officials favor a particular rate level, but we have no way of knowing exactly which official drew which dot. So the dot plot is by no means an official policy commitment, nor does it guarantee the Fed will act accordingly. Think of it more like a collective anonymous report card of forecasts dropped into a suggestion box. So, what's the point of this chart? Its sole value is letting the market gauge the aggregate sentiment inside the Fed, whether the internal consensus is leaning toward tightening or easing. Now let's bring it back to this week's meeting. The newly unveiled dot plot caught a lot of people by surprise and sent a wave of anxiety through everyone advocating for rate cuts and loose liquidity. Most notably, Donald Trump. Quick primer, for anyone new to finance, on the inverse relationship between interest rates and the broader economy. When an economy overheats and inflation surges, that signals too much liquidity sloshing around the system. So a central bank typically raises interest rates. The goal is to push businesses and consumers to park their capital safely in banks or government bonds to earn yield. As circulating money dries up, the economy cools down, and inflation comes under control. Conversely, when an economy stagnates, it means people are hoarding cash, refusing to spend or invest. In that case, the central bank lowers interest rates to make keeping cash in the bank unrewarding, forcing capital back into the real economy to stimulate consumption and growth. Okay, armed with that, let's look at the freshly published dot plot. How exactly should we read it? The leftmost column represents Fed officials' projections for the latter half of 2026. The current federal funds rate sits right at 3.75%. And here's what's striking. Assuming standard 25 basis point increments, 9 officials now believe the Fed will need to raise rates at least once this year. 6 of them expect not just one hike, but a minimum tightening of 50 basis points. Meanwhile, the number of officials who believe the Fed should cut rates this year has dwindled to exactly 1. And keep in mind, just 6 months ago, the absolute consensus across Wall Street was that we were locked into an aggressive easing cycle. Back then, the only debate was, how many cuts will we get? 2? 3? But in this single meeting, that narrative completely inverted. Internal Fed sentiment shifted dramatically in a 3-month window, from when do we cut and by how much, to should we actively resume hiking. So while the Fed appeared to be standing pat on the surface, this meeting was a decisively hawkish turn. The benchmark rate didn't move, but the psychological map inside the committee members' heads shifted entirely. Donald Trump thought he'd ordered a rate cut combo. What he got served was a platter of hawkish tightening threats. Still, here's the silver lining. This is definitive proof that the Federal Reserve's independence remains entirely insulated from political leverage. Whether you personally favor a hike or a cut, that institutional resilience alone should offer real reassurance. Now, if you look really closely at the chart, you'll notice something peculiar. For each projected year, there are only 18 dots, not 19. 1 dot is conspicuously missing. That's because Kevin Warsh himself actively refused to submit a forecast for the dot plot. Why would a sitting chairman do that? This is one of the pivotal insights of today's analysis. From this single gesture, we can see the foundational difference between the Warsh era and the Powell era. To understand why, look at the post-meeting FOMC policy statement. Under Powell, these statements typically ran around 500 words. Even his final one, considered exceptionally brief, was 341 words. Warsh's inaugural statement? A mere 130 words. That's slashing the text by 75%. The defining hallmark of the Powell-led Fed, especially post-pandemic, was its absolute obsession with hyper-communicating with the market. Policy statements were exhaustively detailed, press conferences went into microscopic minutiae, and Powell tried to answer every reporter's question. One governor gives a speech today, another regional president delivers remarks tomorrow. So Wall Street spent every waking hour parsing the Fed's adjectives and vocal inflections, and that triggered a bizarre market pathology. Investors stopped evaluating the actual health of the economy and started solely predicting how the Fed evaluated the economy. Traders stopped pricing organic asset risk and focused exclusively on guessing whether the Fed would step in to bail them out. This dependency has been one of the most deep-seated vulnerabilities plaguing global capital markets over the past decade. The Federal Reserve, designed to be an impartial referee, gradually mutated into a helicopter parent. An institution meant to enforce structural rules turned into a glorified manager of market sentiment. Equities dip. The crowd clamors for the Fed to open the liquidity taps. Indicators soften. The market counts down the days to the next cut. Tech stocks rally. Investors hallucinate that cheap capital will last forever. Over time, the whole financial ecosystem developed a crippling dependency, like a coddled child who looks mature on the outside but can't cross the street without an adult holding their hand. With his first meeting, Warsh effectively let go of that hand. The very first thing he purged from the policy statement was the whole framework known as forward guidance. Stripped of the jargon, forward guidance is just the Fed telling the market well in advance. If X happens, we'll most likely do Y. And that mechanism is inherently a double-edged sword. In an acute systemic crisis, it's genuinely powerful because it anchors expectations. But in periods of relative stability, it easily degenerates from an economic stabilizer into a market narcotic. Traders stop fearing risk because they assume the Fed will flash a warning light well in advance. Institutions stop doing rigorous price discovery because they're relying on the central bank to tip its hand. Warsh's stance is unequivocal. Enough. Read the data yourselves. Manage your own risk. Don't expect the central bank to map out your every move beforehand. In one stroke, Warsh took the burden of macroeconomic uncertainty, which the Fed had voluntarily shouldered for over a decade, and handed it squarely back to the market. And I think there's a deeper layer to this. He's systematically reclaiming the institutional authority of the Federal Reserve. When reporters pressed him on why he refused to place his dot on the chart, Warsh gave a deceptively simple, exceedingly potent answer. He said, "The dot plot is not helpful in the conduct of policy." What he really meant was, don't let today's flexible forecast become tomorrow's binding commitment. He wants to steer the Fed back to the era of constructive ambiguity pioneered by Alan Greenspan. Now, when we say Alan Greenspan, younger investors might not fully grasp his legacy. And coincidentally, just as I was finishing this script, news broke that the legendary former Fed chairman had passed away at the age of 100. Greenspan is undeniably one of the most iconic figures in the history of central banking. He served as Fed chair from 1987 to 2006, 18 and a half years, across 4 different presidencies. And there was virtually no crisis he didn't navigate. Just 2 months into the job, he was hit with the Black Monday crash of 1987, where the Dow plunged 22.6% in a single day, still the largest single-day percentage drop in U.S. history. He steered through the 1994 bond market massacre, the 2000 dot-com bust, and the shock of September 11th. His admirers called him the definitive architect of modern central banking, but he was equally famous as its most enigmatic practitioner. He once said, "If you think you understood what I said, you must have misunderstood me. That was constructive ambiguity in a nutshell. In central banking, that kind of opacity isn't a lack of clarity. It's a manifestation of real structural power. Ben Bernanke changed that in 2012 by introducing the dot plot, giving the public a window into the Fed's internal leanings. Powell then took that communicative style even further. But as the Fed's proclamations got more and more transparent, the market got thoroughly addicted to those implicit promises. Capital markets started pricing in the Fed's reactions long before they even happened. If the market demanded a cut, asset prices adjusted before the central bank even convened. By the time the cut was actually executed, the market barely reacted at all. So ask yourself, under that paradigm, who's really backed into a corner? The answer is the Federal Reserve itself. The most glaring example happened between 2021 and 2022, as inflation started climbing aggressively. Through that entire window, the Fed kept insisting the price surges were merely transitory, and that aggressive tightening wasn't warranted. The market bought that guidance, but in doing so, the Fed became a hostage to its own rhetoric. As CPI kept marching upward, the Fed hesitated to pivot, afraid of disrupting expectations. By the time they finally started hiking, inflation had already broken loose, eventually peaking at a staggering 9.1%. That exposes the fundamental flaw of forward guidance. It creates a structural inertia where the central bank moves far too late and far too slow, simply because pivoting means admitting its prior forecasts were wrong. The Fed's ultimate currency is credibility, and by offering too much certainty, it often traps itself backed into a corner by the very markets it's trying to guide. Which is exactly why Warsh flatly refused to participate in the dot plot. He has zero interest in letting his present-day projections get weaponized by Wall Street to hijack his future policy options. Now, naturally, this philosophical shift has real long-term institutional benefits, but the short-term drawbacks are just as glaring. Under this new regime, expect market volatility to expand, risk premiums to adjust upward, and the structural cost of capital to climb. When the Fed stops feeding the market prepackaged answers, participants are forced to do the heavy lifting themselves. Those with genuinely superior analytical skills will welcome that challenge. Those used to just copying the central bank's answer sheet, they're going to panic. So the real impact of this meeting isn't that rates stayed unchanged. It's that structural uncertainty has officially returned. The great dread of capital markets was never the tightening itself. It's the inability to read the central bank's next move. For over a decade, the Fed suppressed volatility so artificially low that investors started treating it like a permanent law of nature. Now that Warsh is reintroducing genuine uncertainty, valuation models across a huge range of global assets are going to have to be completely recalibrated. That wraps up Part 1. I'll see you in Part 2.